you can't have AI without silver. Supply side, you can just see it in the vaults, all three of them, LBMA, COMEX, and Shanghai. They've just been being drained on a daily basis of physical metal. And that big smash we saw yesterday, that was paper driven. And you can see that because Shanghai, I mean, New York was down, what, $7, $8, and Shanghai was barely down $3. So that finally what's happening is the cash markets coming out in front of the paper markets. The paper markets, the games they've played for the last 50 years, they're coming to an end.
According to precious metals expert Bill Holter, the global silver market is reaching a critical turning point driven by physical supply shortages. Holter explains that modern AI, electronics, and industrial systems cannot function without silver, making real metal availability more important than ever. He points to declining inventories across the world's three major silver vault systems, LBMA, COMEX, and Shanghai, all of which have been steadily drained of physical metal. Holter highlights a recent sharp price drop that was driven by paper trading rather than physical selling. While New York silver prices fell sharply, Shanghai prices barely moved, revealing a growing disconnect between paper markets and real-world demand. This divergence signals that cash and physical markets are starting to lead, while decades-long paper manipulation is losing influence. Holter believes the long-running paper-silver games are nearing their end as physical scarcity takes control of price. Discovery. Now, we present the clips from Bill Holter's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
The futures price should always be higher than the cash price because of carrying costs and interest. That's called contango. When you get the cash price above the futures price, that's backwardation, and that shows that investors don't want to wait 30 days, 90, 60 days, 90 days for their metal. They want to pay for it today, and they want it today. And now, from an exchange standpoint, as you just pointed out, the physical exchange is trading far above, and I mean that premium is blown out to $7, $8. Yeah, about $7 or $8. The cash market, the cash exchange is ahead of the two paper exchanges, COMEX and LBMA. That is blatant, outright backwardation. It tells you investors are not willing to wait for their metal. They're not willing to trust that they're going to get their metal. They want it now. I 100% believe that this structural shift it's permanent. It's what's going to be, it's the future. Paper contracts are not the future. Paper contracts are dying. And the same could be said for the dollar itself. The dollar is dying, and what's going to supplant that will be some type of BRICS currency that has some type of real back. And they, obviously this has been the BRICS currency been in the works for years and years. And I think wiping away the paper markets being able to price metal, I think wiping away that ability is all part of bringing a backed currency forward that can be trusted. You're probably referring to like what happened in 1980 where COMEX said we're not accepting any buy orders, we'll only take sell orders. That was when the world was truly US centric. We were the center of the universe for finance. We were the center of the universe for a lot of things. That's no longer the case. The COMEX could say we're not going to accept buy orders and the price go to $3, but Shanghai goes over $100. What will happen is the rest of the world is now more powerful, if you will, than the U.S., where it used to be the U.S. was more powerful than the rest of the world. I mean, there's no way that they could outlaw buying on COMEX and expect the physical price to go down. Whenever you tell a human being that they can't have something, they want it even more. The Shanghai premium is much smaller. Understand that, gold has been mined for thousands of years, and pretty much all the gold that was mined is still above ground. It's either in storage form or it's jewelry. It doesn't get used like silver. Silver, when they pull an ounce of silver out of the ground, how many different uses are there for that? You've got solar, you've got medicinal, you have technological, you have jewelry, you have just investors buying it. The silver that has been produced over the last few thousand years largely has already been used. There's not any big stockpiles, whereas gold, there are some very, very large stockpiles, and I think larger stockpiles than are being let on. I think Russia and China both have well more gold than what they're letting on.
Bill Holter warns that silver markets are undergoing a permanent structural shift. Normally, futures prices trade above cash prices in contango, but today, silver is in clear backwardation, with physical cash prices trading $7 and $8 above COMEX and LBMA paper contracts. This signals extreme physical demand, as investors no longer trust delayed delivery and want metal immediately. Holter argues this marks the decline of paper contracts and even the US dollar itself. As global power shifts away from US-centric markets, physically backed systems, potentially tied to a future BRICS currency, are poised to dominate real price discovery. Let's get back to the interview.
The weaker the U.S. gets, the easier it will be. Easier it'll be to bring that currency forward. And day after day after day, the U.S. is getting weaker because we're paying We'll pay probably 1.5 trillion in interest this year, and add an additional at least $2 trillion to the debt pile. And I guess you could say debt weakens knees.
That weakens knees, all right. And the incentives, of course, for the US also seem to be aligned with remonetizing their gold to clean up the balance sheet and make this interest problem that you're outlining look a bit less worse. Do you think this BRICS settlement currency could force the US to remonetize as well?
If we were to cover the outstanding debt with the gold that we say we have, you're talking close to $150,000 an ounce. That's where the price would have to go. But that's assuming we have 8,300 tons. And I personally assume that we do not have 8,300 tons and that gold has been going out the back door for years and years and years. 1956 was the last year there was an audit. Gold is money. It's the only currency, gold and silver, the only currencies that you can trust. Everything else is freely printed. Everything else is fiat. So the shock waves will be one of trust. And the shock waves are not going to be held just to the precious metals markets. If silver fails to deliver, and I fully expect silver to fail to deliver in both New York and in London, but when it fails to deliver, that is going to affect all other derivatives because everything runs on trust. And it will probably create much, much higher interest rates in the U.S. because borrowing is done based on trust. And if trust is collapsing, then we'll finally have a risk premium for owning U.S. paper. Now we have 100 contracts standing for delivery the first day, and by the end of the month, it's 200 or 300. So the buyers are coming in during the month and saying, okay, I'm buying the contract, I want the metal. All it would take is one big buyer or a consortium of big buyers to come in and say, I want my metal, and it's completely game over because the metal does not exist to deliver. The retail market is nothing now. The retail market is not even a tailwind. This is institutional money. These are hedge funds. These are private family offices. And in some cases, sovereigns. Look at Russia. They declared they declared silver a strategic metal, and they're buying it. Look at the imports into India. And those are official purchases.
Bill Holter argues that mounting U.S. debt and soaring interest costs are accelerating a global loss of trust in fiat currencies. With over $1.5 trillion in annual interest payments and trillions more added to the debt, Holter believes U.S. financial strength is eroding rapidly. He suggests a BRICS-backed settlement currency could pressure the U.S. to remonetize gold, potentially implying dramatically higher gold prices. Holter warns that silver is likely to fail delivery in New York and London, triggering shockwaves across all derivatives markets. As trust collapses, institutional buyers and sovereigns, not retail investors, are driving demand for physical metal. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.